Market declines. Sometimes they engender paralysis, sometimes running for cover, sometimes lashing out, but almost always discomfort, even fear. But savvy investors understand that while the eventual depth and duration of such declines is uncertain, they present some great opportunities. These include various ways to lower investment taxes, buy attractive assets when they're finally on sale, fuel the long-term growth of your tax-free wealth, and much more. Stay tuned as we reveal 8 ways to harness the widely overlooked opportunities of market declines right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani. Here we've got the regular squad with us today again, Erik Olson and Adrian Nicholson. We have a great topic. Gentlemen, how's life beyond the markets and the financial worlds going for you the last week?
It's been going good. I'm happy to be here. Everything, can't complain too much on my end. Just happy to be here and see you guys.
Yeah, things are going great. Had a wonderful time here for the last couple of days in Boston on a due diligence trip to visit with a particular fund family, and so learned a ton there. So my intellect is nourished in a way that's so fun for me. So anyway, how about you, Roshan?
That's great. That's great with both of you. I actually, for the first time, went to Cape May this weekend and enjoyed going down there. I've never been. It was a little too cold to get into the water at the beach, but there was a nice pool, so we had some fun.
So
That's
Cape May,
awesome.
where's that?
New Jersey.
Oh,
Yeah,
okay.
so we went there to celebrate my niece Malia's first birthday. So that we had gosh, how many people did we have? We had 23 people in the house, and 11 kids. So it was a
Oh, that sounds
busy
fantastic.
weekend, and I was the
Huh.
primary lifeguard for the family. So so it was a good time.
So you had a lot of time
Yes.
on water's edge then. Yeah, good for
I
you.
did. I did. It was fun. But today's topic is I've been looking forward to it as we came up with it last week. For everyone that listens regularly, we talked about the markets and volatility, and today we want to go a little bit as instead of defining the volatility, what happens, and so on. We want to talk a little bit about being opportunistic right now during this time of volatility. So we've given you a ton of data in our previous episode. If you missed it, I would encourage you to check it out because that'll give you the foundation. I think you need to maybe feel comfortable doing some of these more opportunistic moves. Erik's got a great list ready for us today. So, and then Erik, Adrian, and I will discuss the items and we'll throw in any others that come up. So, Erik, I'll let you start us off.
All right. Well, so thanks, Roshan. So I just want to emphasize that this is just as was true last week. We are not making any sort of calls on whether the market has reached a bottom, whether or not there's no. We don't have a crystal ball. We're just talking about probabilistically based on what we've seen in the past. How we want at least history to give us some sense of whether or not there's a lot more downside and or whether there's in fact stuff to look forward to, and whether that's true, at various intervals, 3 months, 6 months, a year out, 3 years out, and so forth. But today, to think about being opportunistic, we're coming at this from 2 different approaches. One are some specific ideas for you that you could consider. Again, these are not prescriptions. It may be too early for them. In some cases, by the time you hear this, it may be actually too late, but at least there are a number of things that you can consider. And then we want to spend the bulk of our time really just talking about how to think about stepping back from specific things that we talk about in terms of the investment approaches, and step back and talk about it from the vantage point of what we talk about with clients most of the time, which is the financial planning side. So let me start with the 6 things, though, that are on the investment side that are sort of, I'm calling from conversations with existing clients about the possible approaches that some of them could take based on their outlook and their readiness for trying to, rather than just shelter themselves, perhaps to try to take advantage of what's happening now. So the first of these is to consider the possibility of shorting. We talked about shorting a little bit last week, but if you didn't listen in last week, or that term's not familiar to you, it's essentially this: borrowing something that you don't own, that is a publicly traded security of some kind, borrowing it from a brokerage firm, selling it at its current price, hoping that later you'll be able to buy it back at a lower price. And whether you do, once you buy it back, whether at a lower price or a higher price, but hopefully for your sake at a lower price, then returning the shares that you've borrowed to the broker. And since this fits the principle of buy low, sell high, it's just the chronological order of doing those two things is reversed. It's sell high, later buy low. Why would you do this? Well, you could do this on certain parts of the market that you thought were particularly susceptible to a further downturn, and use that in part to offset what might still be further downturns in the rest of your portfolio. Or you might think, no, I think other areas of the portfolio are likely to rise, but this one particular sector is still relatively vulnerable. And so I'm going to go ahead and take a short position on that for that reason. Or you might even do it strictly as a just broad hedge on the index to say, I don't know whether or not at this point the market is likely to rise or fall directionally more one way than the other. But because I am uncertain about it and I don't want to absorb much more downturn, then I'll take this short position on a portion of my portfolio in order to uh, win a little bit to offset some of the other losses in the portfolio. In other words, to dampen the overall harm done to your portfolio in the short term. If that happens, you
Yeah.
have the offsetting consideration is that you'll give up some upside if indeed from here on balance the markets are ready to move higher. Gentlemen, what are your thoughts about that?
Yeah, that's a good one, Eric. I think that's a great way to start us off. And when you mentioned shorting, my mind went straight to an exchange traded fund. For example, there are a lot of ETFs out there that are short certain sectors or indices. And just using an example, there are exchange traded funds that short the S&P 500. So if the S&P 500 is going down one day, this exchange traded fund will move up. And again, these are just opportunities, just showing that you can take advantage of markets when they're going down, and also the reverse of markets are going up too. That's your risk involved into it. It just really shows. I think a word that we use in our previous podcast is the investment universe is very massive. There's a lot of different investment vehicles out there to make money when the markets are down. So just looking at all the different options out there is a really good way to start it out.
Yeah,
Mm,
I like the idea. I want to offer a couple words of caution here. One
yes.
is you probably don't want to flip your entire portfolio short, right? And
Hmm.
once again, as Eric said at the beginning, we aren't recommending anything. We're just sharing ideas. What I
Hmm.
mean by that is it and I like to use this as a hedge. And how it fits in with our topic today is I'll call it an opportunistic hedge. I'm not trying to necessarily take advantage of an expected continued decline by trying to profit from it. What I'm trying to do is hedge my current positions to minimize losses. So I would say you really want to be careful with this one. I like the idea. It's great for conversation. It's something great for all investors to consider and think about. At the same time, it can be very risky. So you really want to be cautious if you decide to make this kind of move.
I agree with that. I'm thinking about it in this sort of a setting. If you have, let's say, a portion of your portfolio, I'm just going to say in a conventional 60-40 portfolio, 60% that's allocated to stocks, 40% that's allocated to bonds. At least over the last 6 months or so, the usual lack of correlation between those, or the sometimes even inverse correlation between equities broadly and bonds broadly, has not been there. In fact, they have been positively correlated, meaning they've both been moving down. And as a result, the bonds aren't doing their job as well, or haven't been. I don't know that it's hard to say what happens next, but they haven't been doing their job as well of providing a hedge against the downside that's been occurring in equities.
Hold on. To
And
add to
so
that
if
point, add to that point,
sure,
that was not unexpected. It's worth noting
mhm,
that there, and I
right,
wish I could remember the source to cite it directly, but in if interest rates are going up, bond prices go down. In our current
mhm,
extremely low interest rate environment or no interest rate environment, with the if you consider either real numbers or even the Fed was at a 0 to 25 funds rate,
mhm,
when rates go up, bonds go down. When rates go up, stocks go down in this kind of
mhm,
environment. So
mhm.
I only bring that up right now when you're talking about shorting because, Eric, I see the connection completely. Bonds haven't helped your portfolio, but I'm also making the point that learn from it because you should have known bonds weren't going to help your portfolio.
Yeah. And so in some cases, what we're doing is taking a bit of that bond allocation off the table. And then instead of just having that be in cash, what we're doing is using a portion of the proceeds from the sale of those bonds to then do an inverse move on the equity side of the portfolio using the shorting strategy so that we do get at least a little part of the portfolio actually having an inverse correlation with the broad equity part.
Yeah.
Yes.
So
Mhm.
yeah. Well, anyway, there's
That's a
there's
good
an
idea.
idea, and there's a lot of finessing of the implementation of that, and it's certainly not a uniform application across all clients. So, but at least it's one idea.
Yeah.
So
The,
I
I'm
mean, my final point on this
mhm,
area would be, and you kind of just mentioned it, Eric, just have a shorting strategy if you're going to do this. Don't try and chase the market because just timing it can be very difficult. Where if you have a strategy in place, this can kind of be a better guide for you if you want to implement this strategy and try and profit.
mhm,
The markets are going down or going up, having a strategy other than just trying to chase the market and time it and seeing which direction it can go into
mhm.
is very difficult. And I think, Roshan, you mentioned you have to be right if you're trying to time the market. Sometimes it could be very difficult
uh,
for most investors.
Forget difficult. I don't know many people that have done it well consistently. There's I love giving Buffett and Munger quotes. I don't remember who it was, and I don't remember it word for word, but it's something to the effect of there are a lot of people that have been famous analysts for being right once, right? So you
That's
call,
right.
but to be right, if you're going to do this, you got to be right when you sell and then right when you buy. The odds are stacked against you. One other note I want to make before we move on to number two on this. This one I keep adding notes to because it makes me particularly nervous if someone's going to look into this. Because
Mhm,
one, I do wonder if it's too late. Our previous episode, Eric, you gave all the data about 18% declines and what happens after. And we just talked
mhm,
about how bonds have not helped your portfolio because of the correlation. It could be purely anecdotal, but I've seen in the last few days it looks like that negative correlation has started to come back. What that means
right.
is over the year so far, bonds haven't helped you. But if you narrow that down to the last few days, and it could change, right? These few days could
Mhm,
be anomalies, but on down days, for the stock market, bonds have gone up, and vice versa. So if you're someone that says, "Hey, I didn't put on this hedge, I'm going to go do it now, and my bonds haven't helped me, so I'm going to sell it now," it's a possibility you're doing it at precisely the worst time, right? So I and we don't know that for sure. There is no crystal ball to tell it, but there was a time earlier in the year where if you lowered your bonds, you were putting the likelihood of success in your favor, or if you were adding the hedges, you were putting the likelihood of success in your favor. Right now, I don't know if that timing is right. I love the idea. I would like everyone listening to write it down and save the concept to potentially use in the future. I'm not saying don't use it now. What I'm saying is the odds are not as high in your favor now as they were 5 months ago or 6 months ago.
I think that's a fair statement. All right, I'm going to move on to the next one.
Yes.
So the next in my list of six is going to sound, in some ways, it's going to sound so prosaic, so pedestrian, but I think it's really a very powerful concept, and that is rebalance your portfolio. Undoubtedly, there are certain parts of your portfolio that have dropped more than others, at least if you're not all in one single asset class. So, for example, if I look at the portfolios that I run, it's some of the more growth-oriented positions as opposed to the value positions. It's more the smaller than the larger in most, all else being equal. It's more the biotech and the high, the semiconductor type things that have gotten hurt more so than others. So when you rebalance, what you're doing is you're actually putting more to work in those parts of your portfolio that have been the most damaged. And the thesis here is that while you don't know if it will work perfectly this time, you do know that on balance, over long periods of time, this principle of shaving off some of the things that have held up the best or even perhaps risen, and selling some of those off, shaving some of those off to use the proceeds from those shavings to then go incrementally adding to other parts of your portfolio that are beaten down more. When the reversal occurs, you'll be glad that you had more deployed in those beaten down areas as they recover. Let me give an example of this that hopefully is fairly fresh in most investors' memory. That is when COVID hit, the energy sector got absolutely slammed. So did airlines, so did cruise lines, so did so did hotels. Anything that was, when COVID hit and suddenly everything came to a screeching halt in the travel area, those categories, perhaps more than any others, just got completely whacked. I remember looking at, and I'm going to single out a company, because I'm recommending this company, and I'm not saying it's better than all of the others in the sector. It's just, it is one of the largest such companies in its sector, specifically the energy sector. And I was looking at ExxonMobil, and ExxonMobil was trading at one point at about $30 a share, where it had traded once upon a time back in the late 90s. And I'm thinking, this is not an accurate reflection of the underlying intrinsic value of this company. It makes no sense that this company, the market is currently pricing this company at this level, if certainly not in the long haul. And the same you could say about some of the airlines, as well as some of the aircraft manufacturers. There's only two major aircraft manufacturers in the world, Airbus and Boeing, at least from a commercial airline standpoint. And Boeing was absolutely hammered, as though it was, just the world was just saying, we're not interested. In fact, I don't know if you guys remember this, but even if you step out of equities and you look at commodities, you had for a period of time there to pay people to take oil off of your
Yeah.
hands. It wasn't that it was just down to nothing. You actually had to pay people to get them to take your oil. Do you remember those days?
Yes.
And so here we are, just a short time later, howling about the price of oil. And I know there's been a lot of things that have happened since that time. But my point is simply this, is that sometimes in these moments where there's a disruption, certain things take it on the chin a lot harder than other things do.
Yeah.
And more often than not, it's not because those things have just gone the way of the dodo bird. It's more or less that there's been some sort of really profound overreaction in those particular categories, and rebalancing at that point allows you to do what others are unwilling to do yet, which is to go buy things that are on sale right now.
Yeah, and I'm
Hmm.
going to give a more simple example for the rebalancing. Let's just say your
Sure.
portfolio was half stocks and half cash. I'm picking that because the cash
Mhm.
wouldn't have moved. So you
Right. Good
started the
example.
year with $100,000, let's say, and you had 50,000 in cash and 50,000 in stocks. And let's just say your stocks are down 20% and your cash hadn't moved. Well, now your 100,000 is down to 90, and you've got 50,000 in cash and 40,000 in stocks. What you would
Hmm.
do here to get back to half in each, you should have 45,000 in each. Sell 5,000 of the cash, buy 5,000 of the stock, and you've now done what Erik said. You've bought when everyone is concerned, when the market's down, your portfolio is back in line, and you're all set. There are general historical guidelines I've seen that have said you should rebalance every 12 to 24 months, in that range, just every year like clockwork. There are others that say if your portfolio moves from its target by 5% or so, you rebalance. And in general, that's a good way to take advantage of volatility. Um, years ago, I read David Swenson's book, who ran Yale's endowment fund, and I
Right.
believe they rebalanced daily on their portfolio.
Actually, they rebalanced in some cases every few minutes.
See, there
Wow.
you go. So just
That's really interesting. Every few minutes, because when I heard rebalancing from you, Eric, I just thought of it over like years, because there might be some listeners who are those type of people that are kind of set it and forget it. I'll look at it, let's just say 5, 10, maybe 20 years from now, where rebalancing or considering looking at rebalancing is very valuable. Let's just say you're somebody that is not so aggressive and you're more of a conservative investor, then you should look at rebalancing, because maybe the equity portion of your portfolio has really taken off. It's been let's just say it's been a past couple of years for the stock market. Your equity portion can really outweigh the more conservative areas of your portfolio, and you might not be in line with your risk tolerance. So that's also something really you should look at. If you're a person that kind of is just set it and forget it or buy and hold, just rebalancing over time can be very beneficial for you to be in line with your goals.
It's interesting the interval at which to do this. I think in the case of Swenson and the Yale endowment, they had, of course, super low trading costs
yeah.
and extreme efficiencies in all of that, so that they weren't really having to pay too much of a spread on each of those trades. As a result, in their case, it was relatively frictionless, and they were just taking advantage of these momentary what I'll say mispricings of one asset to the next. But when we're talking about it, the rest of humanity isn't probably going to go about it in that way. The research that I've done in the past on this shows that if you rebalance, you tend to rebalance slightly more frequently, let's say quarterly, versus something closer to every fifth year. The shorter the interval at which you do this periodic rebalancing, the main benefit of that is to reduce your overall volatility, not necessarily to add to the total returns of your portfolio. But those longer ones, especially if you've given some things a chance to really get out of balance, then you do the rebalancing, you've probably allowed there to be some sort of market cycle effect to work in your favor now, and you've allowed the progression of a trend to continue to run for a while before you do that rebalancing. But what I'm talking about is not here, at least in today's podcast, is not an interval based recommendation.
hmm
Instead, it's an opportunistic based recommendation
Yes.
that says when we've seen a fairly sudden disruption of this kind, that presents an opportunity that shouldn't just be left, uh, unused.
I remember the fall of
Mhm.
'08 when Lehman was going under, rebalancing all portfolios 3 times in a 1 month time frame,
Mm.
just because there was
Yeah,
such
because of the movement.
volatility. Yeah, so
Hmm.
for general guidelines, I like the interval approach of I'm gonna do it every, 1 to 2 years, and Eric, I've seen the same numbers you have. I remember I did a back test that said about 18 months is probably a good interval-based time frame, but then
Hmm.
you can do it in an opportunistic way as well when you see big decline, so I definitely like that
Hmm.
one. What's, next on the list, Eric?
Well, actually, you kind of led us into it, Roshan, when you said, "Hey, let me use an example of a 50-50 portfolio
Mhm.
of stocks and cash." Because the next thing it was just going to be revisiting the concept that Adrian had introduced last week, which was if you have spare cash on the sidelines, whether it's right this second or soon, this might be a time to think about putting some of that cash to work. Why? We don't know, as we said before, whether or not there is more downside to this market. And honestly, I would not be surprised if there is. Not at all surprised. And it might be on that basis, at least, that it's a little early to be doing some of it, or at least let me restate that it might be not the absolute most optimal moment in which to do this. But we can certainly say that it's roughly 15 to 20% better right now to do it than it would have been, let's say, 6 months ago. So I think if you look 5 years out from where we are right now, 10 years out from right now, it's probably the case that you'll be glad for any cash that you didn't need to keep as cash. And I think people should have an emergency reserve, and I think they should be saving for other shorter term goals, like that next new car or whatever it is that they're doing. But if there's other cash that sits on the sidelines besides that, I think this is a fair time to put it to work. Any
Yeah,
thoughts about that?
that's where the plan really comes into play here for the individual, because a good plan can show you how opportunistic you can be.
Hmm.
I think that's kind of the overall theme in this episode, just
Hmm.
having that plan set in place where if you're seeing these opportunities or you're hearing about people talking about how there's so many opportunities in the market right now and you have this pile of cash sitting on the sidelines, it's time to look at creating a plan if you've never had one where you can see how much of this money you can really use and
Hmm.
be utilized in your overall portfolio. And like how Erik mentioned, it's all going to be based on what your goals are, what your expenses are, what stage in your life you're in, or how long are you going to need to start withdrawing? How long can you invest? These are all really important questions that need to be answered that your plan can highlight. And I just really like hitting home the point. Just the plan can show you how opportunistic you can be,
Hmm.
which could be very valuable, especially when there's deals in the market or you're looking at your overall retirement.
Hmm.
Yep, I love that idea and that concept, Eric. Like you said, invest excess cash, and what Adrian just mentioned about having a plan that can help you determine what is excess cash.
Hmm.
So make sure you keep the cash reserves you need, but then invest everything else. The only thing I'd
Right.
add is if you look at your time frame when you're investing. So you're making those selections based on your time frame, those investment selections. And then finally, I'll just plug the podcast from a couple episodes ago where Eric, you provided data as to what typically happens after an 18% market decline. If you didn't listen to
Hmm.
that, I'd say check it out because that might make you feel more comfortable taking this step. So if you've
Yeah.
listened to that episode and you say, okay, the markets normally go up for the next few years after an 18% decline, and then second, you run your financial plan and say, okay, here's my excess cash that I could invest for 3, 5+ years. I think that'll help you gain comfort to put that
Mhm.
capital to work in a down market.
Yeah, and I want to actually, just to illustrate that point, I want to share a couple of uh, charts that I've developed for today. So let me just share my screen here really quick, and we'll have a peek at this particular graph. So this is I won't go into a long explanation of this, but this is the Shiller price to earnings ratio, or what's known as the cyclically adjusted price to earnings ratio of 12 major sectors of the U.S. economy. And if you were one of those who, back when COVID hit, took money out of the market, you were really afraid, and you didn't put money back to work, and then you felt so terrible because you felt like, oh, I missed it, and I should have been invested. And by the way, I've had conversations over the last few months with a number of people who were saying, Eric, we've done this forever ourselves, but we just realized, man, we've just been sort of parked here, and we need some help here thinking clearly about how to make these sorts of investments now that we sort of feel like we've missed the boat. I just want to show that some of these sectors that you look at since roughly November of last year, in some cases in January 1st of this year, have had a fairly significant decline over the last 5 to 7 months. And as a result, what you're seeing now, let me just take this blue category here on the far right side, which is, in this case, it's technology. And what you're seeing is that the technology sector, in some ways, is now priced at where it was roughly in June of 2020. Out of the bottoming process was only about 2 months old, and then technology just continued to climb and climb and climb. Some of those technology names are available now at those same price levels that they've been uh, and were prior to COVID and before the big move up. I'm not saying run out and buy technology. I'm just using that as an example. Here's another. Look at this orange one. So, and again, those of our listeners who are just listeners, we're going to have this in the show notes. If you're on our YouTube channel, you'll be able to see this as we go through this. But look at the orange. So this is consumer cyclical. That means more. Sometimes that's called consumer discretionary. That's when you have money that you want to do extras with. What do you deploy it on? Maybe it's a new iPhone. Maybe it's a new, whatever, it might be travel, it might be something else. Boy, oh boy, that had really just shot higher and higher and higher coming out of the COVID crisis. Well, now it's not quite to where it was pre-COVID, but it's not that far above it. It's probably where it was in July of 2020. So that's come way down from what was about 65 on this measure to slightly less than 40 on this measure. And we could go through other examples of this. I'll do one last one, which is in the communication services. So this is this dark brown one that was almost at that same point. It started to really lose its mojo in, let's say, around September 1st of 2021. And that went from, which was in the high 50s, I'll call it 57, 58 on this measure. It's down now to about 31 at this point. This is actually where it was more or less when it bottomed during the COVID crisis. So, on that basis, I would just say when we're talking about rebalancing, we're talking about putting cash to work. It's fair, I think, for us to say that there are meaningful declines in some of these areas where rebalancing and deploying cash can be useful.
Yeah.
Number 4,
Yes.
ready for that, or do you have something to say about that?
Number 4.
Number 4, tax loss harvesting.
Yep.
This is true for people who are in non-qualified or taxable accounts. We're not talking about this isn't if we have an IRA or a Roth IRA, but certainly that's true for if you have taxable money. Gentlemen, you want to just talk about tax loss harvesting for a bit here?
Yeah, taking a loss and using it in a positive way is pretty much the concept with this one, and I really like that as well. Using it to your benefit
Yep.
is really helpful.
Yeah, taking the loss to get that tax write off. Right. Yeah.
Mm-hmm.
I like.
Okay, and yeah, so now some listeners would say, I just don't like to sell at a loss. I'm going to lock it in. No, you don't necessarily lock it in. What you'll do is you'll take the official loss and put that in your capital loss piggy bank to use that to offset gains in the future and really help you manage your taxes in the future. But it doesn't mean that you just have to whatever you just sold, let was say large cap growth in the United States, doesn't mean that you can't reinvest in large cap growth. You just can't do it in the same exact ticker symbol or symbols that you were doing. It has to be, something that's different enough that it's not looked upon by the IRS as really just a superficial action on your part. But done correctly, it's perfectly legit, and it really just helps you on a tax management standpoint going forward. Now, since I just said, let me move to number 5. Since I just said that was a strategy for taxable accounts, what about for tax deferred accounts? I think if you're thinking about doing Roth IRAs, the time that's actually doing Roth conversions, I mean to say, the optimal time in which to do Roth conversion. So here's number 5 is to do the Roth conversion somewhere after a big decline, because here's what's happening. Let's say that you had determined with your tax advisor or your financial advisor that you could keep yourself in an attractively low marginal income tax bracket and still convert, I'm going to just make up a number here, $100,000 from an IRA to a Roth IRA. Would you want to do that at the peak and then put it into the Roth, and then suddenly the Roth declines? Or would you rather do that at the bottom so that as the recovery happens, the recovery is happening in your tax-free category, not in your taxable category? If you're asking me, I'm voting for the latter. You'd like that recovery to happen in your tax-free bucket. Gentlemen, thoughts?
Yeah, definitely the tax-free bucket. That's going to be huge, especially when you're withdrawing from these funds. That's going to be a big deal, saving taxes, that's for sure.
Mm-hmm.
Yep, and I've got completely agree with you, Eric. I love this move. I've got a list of clients who we've been doing Roth conversions that are all going to be getting phone calls from me or emails as soon as we feel like things have stabilized and are turning up to
Mm-hmm.
convert over and then buy in the Roth account.
Mm-hmm. Great. Okay. And so number 6, and this is to consider the possibility of a bit of a pivot into some sectors. And so here's what I'm going to say is we don't know exactly what's going to happen with inflation. We don't know exactly what's going to happen with the markets. But generally speaking, those holdings in your account that tend to pay actual real dividends during these times, especially from companies that are committed to growing their dividends, as opposed to ones they're just sort of, sometimes they pay a giant dividend and then the other times they just drop it. But these companies that have a discipline of lots of strong cash flow and a consistent habit of distributing dividends, these companies tend more so than not to hold up relatively well in these downturns, and you're actually getting a real return as while you're kind of waiting for all of this to happen. So I'm not saying that every dividend strategy is a sensible one, but I do think that carefully done, focusing on high quality dividend paying companies is an attractive place to have some capital deployed right now. And I would include in that utilities. I would include in that real estate investment trusts. I would include in that a number of consumer staple type companies. Any thoughts about that, gentlemen?
For everyone listening, we provide this information not as just giving you areas to look for opportunities, right? And I say that
Hmm.
right now because I will challenge you on this one, Eric. Not that I, in general, don't
Hmm.
like high quality
Hmm. Hmm.
dividend paying stocks. I like them, good part of your portfolio, and so on.
Hmm.
They've held
Hmm.
up so well this year that I'd want to
Hmm.
go fishing elsewhere to dig through
Uh-huh.
the rubble into things that have gotten beaten up more. So I like the
Okay, well
concept.
then.
I just don't know if it fits in my mind, and please tell me how I'm wrong because I'd love to discuss this. To me, this doesn't fit in as an opportunistic move. To me, this move is no longer opportunistic. You should have been there already.
Yeah, I guess you're right. That is more of a defensive play, so I'm going to scratch that, and so I'm going to go with a new number six.
Love it.
And my new number six, replacing that which was I characterized as opportunistic, was more defensive, and that is I think there's talking about certain sectors that have just really gotten slammed. I was mentioning to the two of you just before we started recording today's episode, just what I'm seeing taking place in the biotech category. I think that I'm not saying everybody run out and buy biotech, but I would use biotech as an example, which is something I've been thinking about lately, is one of these categories where wow, it's been a long time since you found generally pricing of biotech companies, right, that's been this beaten up as is happening right now. So there, that's an example, not the only example, and I could talk about a few others too, but I think that's an example of opportunistic investing in places where you said go fishing.
Yeah, and that's what it is, right? You just could look for a place where it's tough to find a great investment. Excuse me. So if you
Hmm.
go to a place where you put the odds in your favor that your time is spent wisely, that's
Hmm.
what I'm looking at. I was go ahead, Eric. What's the next one on your
Well, I
No,
list?
just
that was
wanted to
it.
mention this sounds more like the growth versus value debate, and we had an episode on this previously, where in recent months, a lot of these growth stocks that were really just getting priced in because of their future earnings, their forecasts have really gotten beaten up. And one sector that comes to mind is just technology has really been getting hammered, where your people are looking for deals. What are these technology companies that are reasonable prices now? And then there's the value play, where Eric was mentioning companies with strong balance sheets, cash flow, have a strong dividend is extremely important, have held up very well,
Hmm.
and just seeing if this will continue, or will there be another shift or change, is what people are looking at right now.
Yeah, it does. In my mind, though, that debate's a little bit different because that to me is timeless. Whereas right now, this debate to me is more for current environment, right? One
Hmm.
is we can have that value and growth debate for the rest of our lives, and it's always a good debate, a good conversation. You can find strength on both right now. And
Hmm.
I'm not saying I think there are a lot of cheap value stocks out there as well, right? So
Hmm.
and cheap growth stocks. It's just an area to look. I've got a couple I want to add to your
Yeah, let's hear it.
list, Eric. One of them is is the transferring wealth. If you're similar to doing Roth conversions, if you're transferring wealth to the next generation, to your heirs, Transferring it now when it's down, particularly if you're moving it to a trust where you're moving it the holdings as opposed to cash, there might be an opportunity there. Or even if it is cash that the plan is to be used for investing purposes, maybe now's a good time to move that to the next generation. Like
Hmm.
we have a client, Adrian and I, that we work with that's transferring stock to his kids every year, and then they're selling it. He's following the gift rules, but he's able to transfer it to them, and then they're at a lower bracket. They're also at a state that doesn't tax capital gains, so it makes sense for family planning. Maybe he does that now as that stock
Hmm.
is beaten up, as opposed to
Hmm.
waiting till later on in the year, get more shares
Yeah.
transferred over.
Yeah, I think this is particularly true for those of our clients that have estates that may be indeed at some point subject to estate tax, and whether that's at the state or federal level. By the way, just as a reminder, the current estate tax is thresholds are set to scale with inflation, but they're also set in 2025 at the end of 2025, or let's say January 1st of 2026, barring any further action on the part of the Congress about this, to be cut in half from where their present levels are on an inflation adjusted basis. So if you're a state, you may say, oh, I'm not in any danger of exceeding that amount right now. Would you be if they were cut in half? Then the answer, then that gifting strategy during these, as you were just pointing out, Roshan, might be particularly strategic now.
Yep, and I've got one more to add, which it it's if you have positions you've liked that have gotten beaten up, uh, buying those positions and averaging your price down, not as a general policy, right? In the sense that, oh,
Hmm.
I bought this stock, it's down, let me buy more. No, assuming you fully research the position, you think it's the opportunity has gotten better, not worse, with it going down. It's
Hmm.
a great
Hmm.
way to leverage your time to take advantage of the market. And what I mean by that is it can take months or longer to fully research a company or an investment you like. Well, rather than researching everything new that's gotten declined, look at your portfolio and see if there are really good deals that you think have just gotten. You bought it at a good price and you think it's at an even better price now.
Hmm. Yeah, great. Good suggestion. All right. Well, that covered our list of some of those opportunistic things that were sort of specific. But you gentlemen also had some thoughts about approaching this from the larger, more 30,000 foot level of your plan.
Yeah, and you know what? I think we saved that for a future episode because this was
Okay.
so in depth
All right.
today that I think, and as a teaser for it, as Eric famously does at the end of episodes, we had discussed this on our previous one as well, which was using your financial plan to be your guide, right? And
Hmm.
if you revisit your financial plan, that can help you manage these environments. So that to me
Hmm.
is more behavioral finance conversation, which
Hmm.
is anchored by the plan. And today it's more being opportunistic in this market. So it was my idea to jam them together into one, and I underestimated how much we talk. So I think I think we'll separate that out.
Okay. Well, let me then just let our listeners know as well what to look forward to in the coming 3 weeks. So, next week, we have a representative of one of the largest charitable foundations in the country coming on to talk with us for those about the benefit of generosity and what the research shows about all of this in terms of happiness in life, but also then talking about the mechanisms, whether that's private foundations, donor advised funds, supporting organizations that are available, the pros and cons of each. And so I strongly encourage you next week to listen in on that conversation on generosity and tactical approaches to get the biggest tax benefit from that. Next, we're going to have one of my clients who recently walked the Camino de Santiago in Spain and in Portugal is going to come and talk about that experience. And for those of you who are unfamiliar with that um, journey, it's a pilgrimage of sorts for many people. Hundreds, if not thousands of people actually will walk that every year, and there's quite a story behind it. And the sort of journey for my particular client is the one that we wanted to focus on. And then the week following that, we're going to have on another guest who is going to talk about the how one finds a path forward if one has been wounded pretty deeply by a relationship or in a relationship. And since we're all three of us here very focused on how to have a happy life and a happy retirement, and want you to have a super high quality life during your retirement, but recognize that's not reducible strictly to your financials, but in many ways has to do with just your overall relational happiness and emotional well-being, then I encourage you to stick around for that episode 3 weeks out.
Yeah, we have a lot lined up for everyone. So we've got some good episodes there, and we call ourselves the Retirement Lifestyle Show because even though it might excite us, it's not all about investments. It's about planning your financial life and your overall well-being. So looking forward to those interviews. And for all of our listeners, we always say uh, thank you for listening. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family about us. The YouTube channel is taking off as well. So if you want to watch instead of listen, feel free to join us over there. And we'll be back next week with another great episode. This has been the Retirement Lifestyle Show.